the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show. Let us take you through what we have in store in today's episode. Our cover story is about Business Standard Banker of the Year 2021-22, Shashidhar Jagdishan of HDFC Bank. In Banker's View, Jamal Mecklai, CEO of Mecklai Financial Services, joins us to talk about currency markets and inflation targets. In Banking for You, we will explain all about the up-and-coming trend of greenwashing. Later in the show, our consulting editor, Tamal Bandhopadhyay, chats with us about RBI's supervisory role. And drawing things to a close, we will tell you the last week poll results and also share with you the poll question of this week. Keep watching. HDFC Bank's MD and CEO, Shashidhar Jagdishan, is the Business Standard Banker of the Year 2021-22. HDFC Bank continued its strong performance under his leadership while successfully navigating technology-related challenges. In our cover story, Manojit Saha tells us more about his becoming the Business Standard Banker of the Year 2022.
An eminent five-member jury chaired by former Reserve Bank Deputy Governor S.S. Mundra selected the 58-year-old Chief Executive of the country's largest private sector bank as the Banker of the Year. Shashidhar Jagdishan's journey at HDFC Bank started in 1996 as a manager in the finance function. His initial days as the CEO were not smooth. Just after a month of appointment, in early December 2020, the banking regulator barred HDFC Bank from onboarding new credit card customers and launching new digital products due to repeated outages in the bank's mobile and internet banking platforms. The regulatory action was a big blow to HDFC, which was by far the largest credit card issuer in the country. In a rare gesture, Jagdishan apologized to the bank customers after the RBI action and went on a war footing to plug the gaps. By the end of 2021-22, satisfied with the bank's efforts, the banking regulator decided to lift all the bans, a testimony to his leadership during a crisis, which was also noted by the jury. Quote, HDFC Bank continued to register a strong financial performance, augmented shareholders' value, and growth ratios are impressive despite a much larger base. Jagdishan navigated the bank smoothly through the technology challenges it was facing when he took over the reins. This is also a recognition of his leadership skills. Unquote. The other jury members were Vice Chairman and CEO of HDFC Limited, K.K. Mistry, Icon Investment Advisors Chairman Anil Singhvi, Aditya Birla's Sun Life Asset Management Company MD and CEO A. Bala Subramanian, and former MD and CEO of Bank of Baroda, P.S. Jayakumar. Known to his colleagues as Sashi, Jagdishan took charge of HDFC Bank on 27th of October 2020, after his illustrious predecessor Aditya Puri demitted office after turning 70, the maximum age for a CEO in a private sector bank according to RBI norms. The banking regulator approved Jagdishan's appointment for 3 years, after which he is eligible for an extension. For the financial year 2021-22, HDFC Bank reported an 18.8% increase in net profit to 36,961.3 crore rupees, backed by an 11% increase in net interest income to 72,009.6 crore rupees. Analysts said that deposit mobilization was critical for the bank to fund a balance sheet of 20 trillion rupees after its merger with HDFC.
In terms of challenges, while it has been a very eventful journey because he has been at the helm of the bank just for a little around 3 years now, and he has already faced and very skillfully handled the banks in these difficult situations. I think incrementally going from here, the deposit franchise is going to be very critical. Bank has been very vocal and looking to step up the deposit mobilization run rate. And in an environment wherein deposit rates are moving up very sharply, and almost every bank is fighting hard to the best of their ability. And for HDFC Bank, given how the merger is also going to happen, and therefore to fund the combined loan book, on the back of deposits, it has to in fact raise even more quantum of deposits, for which we believe bank is on track. It's preparing well. And already, if you look at the pace of branch expansion, wherein they have expanded considerably, I think this over a medium term, not in the immediate term, because it takes time for branches to scale up and then to break even and generate as much business. But in the medium term, we expect that these branches will be playing an instrumental role in raising the required quantum of deposits.
HDFC Bank, which had an 11.2% share of the loan market and 9.5% share of deposits by the end of 2021-22, is the most valued lender in the country with over $100 billion in market capitalization. With over 70 million customers and 6,300 branches, the bank had a total business of close to 30 trillion rupees by the end of FY22, second only to the behemoth State Bank of India.
Jagdishan's journey as the HDFC Bank CEO has seen many ups and downs, but he has navigated the bank through difficult times, making it one of the most valued lenders in the country. Moving on to our next segment, Jamal Mecklai, CEO of Mecklai Financial Services, spoke to Bhaskar Datta about the Federal Reserve's resolve to push inflation down to 2% and what it would mean for the currency markets. He also talked about the recent step taken to link UPI with Singapore's Pay Now system and how that could help the Indian currency.
For financial markets across the world, the defining characteristic of 2022 was the US Federal Reserve's decision to embark on the most aggressive monetary tightening cycle seen in around 40 years. With the US dollar consequently strengthening across the globe, emerging market currencies like the rupee face pressure. We have with us today Jamal Mecklai, the CEO of Mecklai Financial, to share his views on the movement of the rupee in the current year. Mr. Mecklai, a veteran in India's currency market and treasury risk management landscape, will take us through his expectations for the rupee amid an unprecedented global policy environment. Welcome to the show, Mr. Mecklai. The experience of 2022 shows us that it's risky to predict an end to the Fed's rate hike cycle. Of late, we've seen that likely support from the RBI has kept the rupee from reaching the 83 mark, even as US data suggests more Fed tightening. Where do you see the rupee over the next couple of months?
Babu, I always say I have no idea, right? I think fundamentally, you need to look at, I mean, you've been talking, the Fed is the main game in town. I think people are finally beginning to believe globally that the Fed is not done tightening. It's going to continue to keep rates high. As a result, equity markets are very, very nervous. My personal belief is there is a bigger problem. The bigger problem is that, the Fed and recently the ECB repeated that they're going to do what it takes to bring inflation down to 2%. Now, I think that is the problem, because I think the 2% target was set on a different planet, right? It was set when globalization was smooth, when China was selling things as cheap as they could, and it was great work, I don't think we're certainly not in that world now. And so I don't think they're going to be able to get inflation down to 2%, right? They will get it down, if they continue to hold rates up. But to my mind, the terminal rate, the target needs to be different. Now, the big problem is if the Fed any day says, okay, I'm not going to take it to 2, I'm going to take it to 3.5, markets will lose their mind. So I think there is some major trauma to come out of that. Okay. Now, of course, we're in India, the rupee is what we're looking at. Now, whenever there is this kind of dramatic nervousness, risk off, etc., naturally people pull money out from everywhere, right? Including India. Plus, we have this continuing problem with our current account, right? Now, on the other side is the RBI, where at every meeting, Mr. Das says, we can manage it. and they are showing their muscle more particularly recently. I mean, despite the whole Adani story, etc., it has not fallen below 83. In fact, it strengthened, 30, 40 paisa the last couple of days. Now, it's dangerous to think that they can hold it, forever. On the other side, if you really look at purchasing power, I mean, the Economist had a thing saying the rupee is 40% undervalued. You look at anecdotal evidence, it's dramatically undervalued. So I think it's good that RBI is preventing it from weakening. How long will it be able to hold the tide? I don't know.
So you had touched upon the FPI flows, or basically the overseas flows. So we saw that 2022, it was a year of large FPI outflows from equities. And so far in 2023, it's been a little volatile. And we also know that India's GDP growth is expected to slow down, albeit less than many others. So what can we expect on the flows front?
Well, as I said, flows are going to be driven by, portfolio flows will be driven by risk on, risk off overseas. I think it's going to be risk on, for a long time globally. So obviously portfolio flows will not be that strong. However, I think India's GDP growth, these numbers, the reality is we've got a huge market, lots of opportunity. So I think FDI is going to be strong. Now, whether it will be able to increase faster than the drop in the portfolio flows, I don't know. But so it's going to be tricky. That's why we come back to the rupee. How well will RBI be able to handle it? They seem to be doing a good job right now. In fact, one of the things that actually pisses me off is, this model that we talked about uses volatility. Now, RBI has been containing volatility. So I'm getting wrong signals from that, right? We're still doing well, but I don't know how to get around that. So we're working on it.
So last year, we had seen that in July, the RBI had announced certain steps for further internationalization of the rupee. There's been a lot of global debate about the de-dollarization theme. So by when do you think that we could see a meaningful internationalization of the rupee, so to speak?
I think it's going to be a long time. Basically, we're using it for trade in a few sort of narrow channels is all very well. But the bulk of our trade is in dollars, euros, yen, Now, that change is going to take a long, long time. Our markets need to be much more liquid, And it's important. I'm not sure how critical it is. We've got a lot, but I will say one thing though, having said that, this whole, more exciting than the internationalization has been that this UPI thing with Singapore.
Yeah.
Now that's really India's strength. So that would be great if we could really get hooked into using our systems for cross-border flows, right? Banks won't like it, but hey, they've been fat over the years, basically on that, So I think that is one good thing, and that should make basically everybody more efficient.
That's all in this week's episode of The Banking Show. Thank you very much for taking the time out for us, Mr. Mecklai.
You're welcome. Good luck. Yeah, bye.
Mecklai believes that the larger problem at hand is the Fed's inflation target of 2% itself. According to him, that target was set at a time when globalization was working smoothly and international price pressures were of a different nature. As the discussion around climate change intensifies globally and companies face the pressure of decreasing their carbon footprint, a new term is also gaining traction: greenwashing. In simple terms, it is fudging climate goals. Banks too are taking note of these practices. In our next report, Raghu Mohan tells us more.
Greenwashing is the wrong end use of capital due to a plurality of definitions and majority mismatches between long-term green investments and the short-term interest of investors. Or, simply put, the sums raised and earmarked for green purposes have to be utilized for the same. It calls for policy action to establish a framework that promotes the green finance ecosystem by fostering awareness through coordinated efforts involving all stakeholders. The issue is of critical importance. According to the government's preliminary estimates for the Paris Agreement, we would need at least $2.5 trillion at 214.15 prices to meet climate change actions between 2015 and 2030. The Reserve Bank of India is also working on a green taxonomy. M. Rajeshwar Rao said at the Business Standard BFSI Inside Summit in Mumbai on December 22nd last year that a formal definition of green finance along with a taxonomy is the need of the hour, as it would enable more precise tracking of finance flows to green sectors in India. This would help design effective policies, regulations, and institutional mechanisms to increase public and private investments. A taxonomy would also help banks and financial institutions in better assessing the climate risk in their loan portfolio, scaling up green and sustainable finance, and mitigating the risk of greenwashing. Rao said, the central bank has sensitized the public, investors, and banks regarding the need, opportunities, and challenges of green finance through regular reports and other communications. For instance, in its annual report 2015-16, the RBI mentioned the findings of the G20 Green Finance Study Group on the need for the development of local green bond markets, facilitating cross-border investments in them, knowledge sharing on environmental risks, and improving overall green finance activities. The report further mentions the broader issues related to green finance that need future consideration. These include definitions of green activities, aspects of intellectual property rights in developing and transferring technology from developed countries, and environmental risk assessment by banks. A related issue in scaling up green finance is the availability of a robust ecosystem for third-party verification, impact assessment, and the green credentials of businesses and projects. It may be recalled that in the first fortnight of January, the Export-Import Bank of India raised $1 billion in green bonds priced at 190 basis points over the 10-year USD bill. The deal was the largest such issuance by an Indian entity. Right after came the maiden auction of the twin sovereign green bonds for a cumulative 8,000 crore rupees via 5 and 10-year papers. And the last week of February saw 244 crore rupees float in the same genre by the Indore Municipal Corporation, being oversubscribed 5.91 times and listed on the National Stock Exchange.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Greenwashing should trigger some policy action soon. As Raghu said, the government would need to establish a framework that promotes the green finance ecosystem and increase awareness by involving all stakeholders. And while RBI is working on the green taxonomy, it is the supervisory role of RBI that has evolved and expanded a great deal in recent times. And that is what I spoke about with our consulting editor, Tamal Bandhopadhyay, for this week's Take 2. Here's what he had to say. Hi Tamal, welcome to the Business Standards Banking Show. Today we are discussing how RBI's supervisory role has evolved over time. And of course, you have written your latest column also on the same subject. I'm reminded of the question that you asked Shaktikanta Das in the fireside chat that you had in December, that is RBI micromanaging. Why did you ask that question? Do you think there has been a big shift in the way RBI supervises?
Well, I don't think it, but the bankers think it. The regulated entities, the supervised entities think that way. And that was a provocation. In fact, the fireside chat you were referring to was at this newspaper's Business Standard BFSI Summit in December. A large part of the banking and financial system were present there. And yes, in private, many bankers confide in me that this Reserve Bank of India is becoming a micromanager. Now going beyond its supervisory role, it's getting into the business model of banks, and it's breathing down on the bank's neck, every bank's necks. So that was the provocation. I asked Governor that has RBI become a micromanager? And you have seen his answer. You've heard him.
How has the method of supervision changed?
Well, it has changed. We need to go back a little bit. Earlier, the basis of supervision was something called CAMEL, CAMELS. Each letter stands for certain thing, like C for capital. I'm not getting to the technicalities. Then Reserve Bank of India, sometime mid next decade, shifted to something called RBS, risk-based supervision. And so from, again, going back, it was basically on-site based supervision earlier. Essentially, RBI was getting into the banks headquarters and interacting with the bankers and picking up data, etc. From there, it shifted to mostly off-site supervision, which is basically you depend on the data flow and all. So that's what RBS. And now what we are saying is a combination of what RBI is aiming at, combination of very intense on-site as well as off-site supervision, meaning depending on the data, AI and ML, how this how this world of data world is evolving. RBI is keeping a very close track on that off-site part. On the at the same time, it's also not being lax on-site. What was happening is, when after the RBI's focus was shifted more to the off-site, and on-site it was primarily on the RBI radar was the bank headquarters, but say important branches, treasury offices, etc., was not necessarily on the RBI radar, and which is why you have seen that that infamous Nirav Modi scam happened under the nose of Reserve Bank of India. On the Honeyman Circle, little office, which is about 100 meters away in Mumbai, on the Mint Road. The entire thing happened there. RBI was not allowed on that. So now what we are saying is a combination of off-site and on-site, but very intense, which bankers are finding a little bit of claustrophobic. But RBI is saying, look, this needs to be done, because I think it's wiser with the experience, because what happened with Yes Bank, we know. What happened with some of the NBFCs, large NBFCs, we know. So Reserve Bank of India, I think earlier it was reactive. Now it has become very proactive.
You say that it's reactive and not proactive. In your column, you have called it like a sniffer dog, and how it is looking at activity-based approach instead of entity-based. Do you think all these things are step in the right direction? Is it good or bad?
Well, yeah, you have raised the right point. It's activity-based, not entity-based, which is why what we are saying is this RBI earlier inspection or supervision was in isolation. Like the banks will be treated in some way, non-banking finance companies will be treated in a different way, little softer touch, and UCBs, that is urban cooperative banks, was outside the RBI's ambit. But now UCBs, urban cooperative banks, also now come under RBI supervision through a change in the act. Now RBI is now looking at all the financial intermediaries, that's banks, non-banks, and UCBs holistically, which means it does not want, it wants to prevent any spillover from one sector to another sector. That's why it is taking a close look at all the entities to make sure that if something happens, there is no systemic risk. To use a cliche, nipping in the bud. So that's an approach. Is it good or is it bad? Well, I am not qualified to say that, but bankers are, not every banker is happy. In private, bankers do say that RBI is doing micromanagement because this is not a regulator's job. Regulator does not know the business model, should not interfere in the business model. Earlier, what was happening is this: RBI used to just send a circular, do this, do that, and we used to say that, like, apple a day keeps the doctors away, so a circular a day keeps the non-performance away or kind of stuff. But now RBI is on the other extreme. It's not a circular a day anymore. RBI is getting into the kitchen of each bank and just checking what is cooking. Definitely, bankers will not officially say they are not happy about it. But is this the things needs to be done? Because of our experience, what happened in Yes Bank, what happened in some of the large NBFCs, is this the way to go? I think we need to wait and watch how the things evolve.
I usually don't ask you this, but because you're saying how the bankers feel about it, what is the kind of reaction you got to what you have written in your column?
Well, that's a pretty smart question, I must say. This is one of the rare cases where I did not have to wait for Monday paper to come out to get the reaction. I started getting reaction from Sunday evening onwards when Business Standard put it up on the website. It's good and bad. There are entities I'm not definitely named, but they're all big guys. Some of them saying it's pretty good what Reserve Bank of India is doing, and some of them are saying no, it's not. And one particular person has asked me that if you ask the jailer, if everything is good in the jail, what's happening? Will the jailer say no, it's not? But is the jailer doing the right thing? We need to say. It's basically, some of them are saying it's not, RBI is not following a principle-based approach. It's still a rule-based approach, which is pretty primitive, which some of them are saying. But equal number of people also saying that what Reserve Bank of India is doing is pretty good, because we had the experience of, pretty bad experience of a few banks and some of the large NBFCs. So this is the way to rectify it.
Absolutely. We will continue this discussion in our next week's episode. Thank you so much, Tamal, for joining us today and sharing your thoughts. RBI's role as a supervisor has certainly expanded. And as Tamal puts it, the central bank is getting into the kitchen of the future of the bank and checking what is cooking. Perhaps RBI is right to be proactive and not reactive. It is a wider discussion that we will pick up again next week. And now to our poll results. We asked you last week, should you go for a higher pension under the new EPFO scheme? 66.4% of our respondents said yes, while 33.6% said no. A good credit score can help you get better rates when you apply for loans. Each lender has their own criteria for credit scoring as well as their own thresholds for a good score versus a bad score. We are asking you this week, are you happy with your consumer credit scoring system? Our polls open on Friday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.